Hello, everyone. Today on the Final Bar, we'll kick this week off by looking at how the markets have traded on this Monday. We had a shortened holiday week last week. Today, we're going to talk about this continued retracement. Some of the leadership names like NVIDIA, AMD, some of those mega cap growth stocks continue to pull back. Tesla having a particularly weak day. Is this the continuation of a further drawdown for some of those previous leadership names? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks so much for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. The technical toolkit is really optimized for investors to understand and really appreciate the supply and demand in the markets. There's so much speculation about what could happen, what should happen, what might happen. At the end of the day, as one of my mentors, Ralph Akinpour, would always say, price is fact. There's no denying that shares traded hands at this particular level at this particular point in time. By analyzing those prices over time, a lot of great academic research and broker research has proven that there's value in looking at the charts and trying to understand the shifts in price momentum. We'll try to do our best here in a short time every weekday after the close to help you make sense of these markets. And let's get right to our market recap. Wanted to start, by the way, with the poll. We always have a poll going on our social media accounts and, of course, on our YouTube channel. So make sure you're subscribed to that if you're watching this on YouTube. And we asked you recently, where is the S&P as of December 31st, 2023? I'm often asked at the beginning of the year to give some year-end target. It is incredibly difficult to pick where the mark is going to be, but it is a really interesting poll question. It's an interesting way to gauge from a group of people, where are we sort of at? What strikes me as I'm looking at the results is how evenly spread they are, right? The biggest response was 30%. The lowest response was 19%, which means there were votes in pretty much all four of these buckets. I would say Final Bar Nation, no overwhelming position to be taken here, except that most of you saying, the most common answer would be below 4,200, which means overall there's sort of a negative tilt to it. But overall, if I would group above 4,500 versus below 4,500, it's kind of even. So let's look at the chart of the S&P and just see where we're at right now and how that relates to the poll question here. So 4,500 is sort of this level. It's just above the high that we had about a week and a half ago. Bring in a little more data here so we can see where we came from. Yeah, so 4,500 is sort of right in this range. So I basically said between 4,500, just above that recent high, all the way up to all-time highs. 25% of you said a new all-time high at year end. 30% of you said way down here below 4,200 at year end, and then the rest of you kind of in the middle. I'm fascinated by this poll. We could spend a whole hour just talking about the different results in here. I didn't vote. My year end target, if I remember, it's kind of a blur. I remember saying something like 43 or 4,400. I don't think it was not too far from current levels. I might actually stand by that as a pretty decent year-end target. But again, what's beautiful about technical analysis, that sort of question about where we might be 6 to 12 months down the road is more of a fun, water cooler conversation. For me, it helps you stretch your thinking, right? What would it be like if the S&P was above 4,800 at year-end? What would the end of the year be like if we were below 3,800, right? And thinking about some of those different barbells and the extreme moves and what that might actually represent. And then think about what the most likely scenario is, and then position yourself for that, but be mentally prepared for those other requests. Really great. I appreciate you guys answering that poll. We had a new poll question that just went out before the show, so make sure you respond for that if you have not already. Let's continue our market recap. As I mentioned in the introduction, sort of a weaker day for growth, and that's been a theme we've talked about here for a couple weeks. Over the last week or two, I've certainly seen a big rotation, right? Doing this show every day, it was all about the narrow leadership, the NVIDIA chart, the Apple chart, the Microsoft chart, the Netflix chart, these great examples of these mega cap growth stocks having this brilliant run that was just continuing to push higher and higher. All of a sudden, that starts to change. And about 2 weeks ago, we started to see some question marks, I would argue, with a lot of these stocks becoming overbought. Some bearish momentum divergences, like we saw on the chart of AMD. Now we're seeing more and more of that as the NASDAQ sort of leads the way to the downside. A little a rollover going into the close today, and so the Nasdaq composite actually finishing lower by about 1.2%, finishing the day around 13,340, just below that. The S&P 500 closing the day about 0.5% lower, that's just below 4330, and the Dow finishing just basically flat for the day. Now it was up quite a bit, around 33,820, but sold off to get just narrowly in the red. Just as we were getting ready with the show here. Mid caps and small caps actually having a decent day to the upside. I think that has a lot to do with the sector leadership, right? The growthy sectors struggling today. Some of the more value, income-oriented sectors doing a lot better. The VIX ripping to the upside, but still way low compared to where we've been over the last 12 months. So don't get too excited. We're still just around 14, which in VIX speak is pretty low, right? The average VIX reading last year was sort of in that 20 to 35 range. Back in 2021, it was more in the 10, 15, 20% range, or not percent, but 15, 20 range. And now we're in around 14, coming off of a 13 handle last week. So a bounce higher, getting back above 14, but still relatively low compared to where we've been here in recent history. Let's look at some other asset classes here. Interest rates overall moving higher. The 5, 10, and 30-year points, moving lower. All the 5-year and 10 and 30-year points all coming down just a bit. 5-year yields around 396, the 10-year yield around 372. And that 10-year point tends to be the main one we've looked at. If you look at the chart of $TNX, which is the 10-year yield, not a big directional trend here over the last couple months, right? It's been sort of sideways. And what's interesting is as the language from the Fed has been, incredibly hawkish, and I would say consistently hawkish now as we have paused the rate hikes, but now there's very much an expectation that the rate hikes continue. And I think the real risk for the markets here is that the rate hikes kind of go above and beyond what is needed, and all of a sudden things can get really dangerous very quickly if the economy is made to slow down too much. And then all of a sudden, consumers really feel the pain, and that starts to really affect companies going forward. We haven't necessarily seen that, particularly with the growth names that we've been tracking, but the average stock has been struggling in 2023, and maybe that's a big part of it. So for what it's worth, 10-year yields coming off today. The dollar index, not too much of a change from yesterday. The UUP essentially flat, down about 0.1%. Elsewhere, we have gold slightly higher, but silver a little bit more higher, up about 1.6%. And that might be interesting because we've talked recently about gold and silver. If you take a trend line or a trend channel off of the lows for the last 6 months or so, sort of broken down through that trend channel, really testing key support levels, now bouncing to start the week here. That might be an important theme to watch to see if we get a continued rotation away from risk assets like growthy equities, and more into defensive areas of the market like gold or silver. Certainly an emerging theme to pay attention to. Crude oil prices bouncing nicely today, up about 0.5% using the USO. Cryptocurrency settling down a bit. Last week it was all about sort of this new emergence of an uptrend from Bitcoin and Ether, both of them testing new highs for 2023, both of them coming off just a little bit. Ethereum prices here in the last 24 hours down about 2.3%, Bitcoin less than 1% lower, still holding above 30,000. And big round numbers I have found with something like Bitcoin incredibly meaningful. So I'm thinking of Bitcoin at 30,000, Ether at 2,000. Those are important levels to watch. And just look back on the chart how many times those big round numbers have had meaning. There's a reason. It's been proven academically as to why we tend to gravitate around those big round numbers, but it's certainly happening here right now. Let's look at a daily chart of the S&P quickly. As I mentioned, we talked during our poll question about where things were at. My base case for what I'm seeing here is we've had a really incredible rally from mid-March to mid-June. You've seen a real influx of demand and breadth conditions turning quite positive, if not overly positive, particularly in the growth space. We're now seeing all of those growth stocks becoming overbought, and now all of those things coming off. The S&P 500 itself, the Nasdaq, both overbought conditions over the last week and a half, now alleviated coming back. So for the S&P, my short-term line in the sand, the level above which I don't think we need to be worried too much is 4,300. We are still holding that as of today's close. As long as we keep holding that, I'm not too worried about it. We start breaking 4,300, I think you need to start really thinking about downside potential, managing that downside risk. My conversation last week with Bob Lang comes to mind. Things are okay. Things are still fine. Things are not horrible yet. by any stretch of the imagination, but this is a really good time to be thinking about downside protection. What can you do now to protect yourself in terms of a game plan, in terms of levels at which you would reconsider a position, stops in place, but also in terms of other things. Can you use the options market to gather some income and gather some premium and protect yourself? Covered calls sort of strategies to at least cushion potential downside. Really good time now while the losses are minimal on any sort of drawdown phase. I wanted to show you briefly the advanced decline lines. I was preparing my report for my market misbehavior premium members on Saturday, and I was looking at this chart in a little more detail, and it just strikes me the contrast between the large cap space and the small cap space. These are the advanced decline lines for 4 major groups of stocks: the New York Stock Exchange in the top, and then the large cap, mid cap, and small cap S&P 500 indexes. And if you look, the breadth on the New York Stock Exchange has not been overwhelmingly positive. While the S&P has gone from a higher low in March and made, really threatening the August 2022 highs, every upswing has had a lower high for the advanced decline line. So talk about not confirming the move in price. This is what I'm seeing. When I talk about the breadth conditions not being overwhelmingly positive across the board, something like this comes to mind. The small cap AD line actually made a new low and is threatening a new low, actually just today, making a new low for the year, it looks like. That might have been on Friday's close, actually. This isn't updated yet for today, but as of Friday's close, making a new low for the year. So you're certainly seeing weakness in small cap. There had been a bit of a bounce, but now you're seeing in the S&P 600, in the Russell 2000, continued rotation to the downside. That's the danger to this market, is that growth stocks retrace and that these other areas of the market are still struggling. That all of a sudden can weigh very heavily on our major benchmarks for sure. Quickly, I just wanted to look at 2 sectors, real estate and energy. And the reason is because these are 2 top sectors today. And I forgot to look through the sector returns. Sorry about that. Let's look at the 11 S&P sectors. I just want to point out real estate up the most, up 2.3%. Energy, number 2, up 1.8%. Materials and utilities, both up about 1%. These are not sectors we've been talking about a lot at the top of the list. It's been a lot of these sectors, the FAANG sectors, which are the 3 at the bottom. Consumer discretionary, the XLY, down 1.3%. Now, Tesla having a really tough day today after the weekend. That's weighing heavily on a cap-weighted ETF like the XLY. Communication services down 1%. Technology down 0.7%. So you have defensive and more cyclical leadership at the top. You have growth stocks at the bottom. And again, the way our benchmarks are calculated, that is really going to weigh heavily on the S&P, especially on the NASDAQ, which is basically underweight all of these and overweight all of those sectors at the bottom. So, worth recognizing when the S&P or the NASDAQ are up and down. A lot of times it has to do with some of those sector themes. Now, with that in mind, let's look again at the XLREs, what I want to get to. This is the biggest gainer today, up 2.2%. When I talk about multiple timeframes and the importance of that, a day like this is one of those days where I think it's really important. You see something like real estate up today, but is that really an encouraging sign yet? I mean, it's encouraging for today, right? And if you're a day trader, if you're a swing trader making a 1 to 3 day move, absolutely. Is this a mean reversion, retesting the previous swing high? Perhaps. But as a medium-term, long-term investor, there's nowhere, not nearly enough evidence, I would argue, to indicate a broader rotation into real estate. And the reason why I would say that with high conviction is the relative strength line at the bottom. This is showing you the trend in real estate versus the S&P 500. The trend has been down for a year plus, with some notable exceptions, right? Coming out of the October low of last year, worth noting, real estate actually did quite well on a relative basis. But overall, in 2023, real estate has been a really tough sector. So when you see a bounce like this, I immediately am drawn to the trend and the relative strength, because that tells you, has this been enough of a move to really change the conviction in these sectors, really change the relative story? And I would say no. By the way, another great way to visualize this is with Julius de Kempener's work, the RRG, the relative rotation graph. You'll see what real estate would need to do to really be a constructive performer on a relative basis using that rotation. One of our questions, by the way, in the mailbag, which we'll hit a little later in today's show, hints on that relative rotation graph. So I'll save any further comment for that segment in a short while. The other one I want to highlight was energy. Energy was number 2. And again, we highlighted on Friday's show the inverted chart of some energy. I forget what it was, DVN or one of those, Chevron maybe. But one of the common techniques you can do to sort of rethink a position or rethink a perspective on a chart is to invert the scale, right? Put the little minus sign before the ticker. And if you do minus XLE, you see what I would argue appears to be potentially a really positive rotation, right? Sort of this low in November, higher lows in January, and then in April, another higher low in June. We're kind of testing resistance. Too early, arguably, right, to get it, but you're sort of having this cup and handle type of pattern. A break above 75 would kind of, maybe complete that. And that is the XLE plotted upside down. So if we make the regular scale again, we were sort of inverting this pattern here. And you can see the high in November, lower highs in January and in April. We're now testing support. Again, I think we need to break down through 75 to complete that. But today's sort of counter trend move is coming off of a fairly weak chart. What would make this chart more encouraging? And I would argue it's making a new swing high, making a higher low, getting above the 200-day. These are things that it really hasn't been able to do over the last couple months. And if it's able to do that, then you can start to say, all right, energy, real estate. These are sectors that are not just one and done type of bounces. These are actually starting to rotate a little bit higher. So I'd be looking for there, not there yet. Now, just to finish off here, and then we'll reset a moment before the mailbag. Charts like NVIDIA concern me quite a bit. And the reason is because a chart like NVIDIA gapped higher in May, moved higher, and you had these higher highs end of May, mid-June, up to 440. But look at how the momentum is actually sloping downwards. Lower peaks in the RSI, and now we're selling off on a day like today, and it's sort of a very expected, I think, reaction to the fact that we're pushing to new highs on weaker momentum. And so watching to see if we continue to rotate lower, I think that's an important chart to watch this week. Tesla is another one, and the charts of NVIDIA and Tesla strike me in that they have been overbought. These are the names that have really been powering the benchmarks higher. They've been powering ETFs like the XLY and the XLK to new highs and really pushing our growth-oriented benchmarks higher along with those. These sorts of names rotate lower. It doesn't matter how many Chevrons or how many Huntington Bank shares or some like names like this in energy and financials. There are not enough of them out there, and they're not big enough to move the needle on our benchmarks higher. So those stocks could actually do quite well. Real estate could rip to the upside. Utilities could do very well. But if Tesla and NVIDIA and Microsoft are doing this sort of thing, coming out of the overbought region and really pulling back 5 to 10%, watch our benchmarks struggle as they try to keep up with the biggest names struggling in a pretty big way. That's our market recap here for Monday. Bit of a dark turn here as I'm finishing with the exclamation point of the rotation lower, but I have to base it on the evidence. And at this point, I'm certainly seeing all those signs of the rotation lower. By the way, just wrote an article for StockCharts.com on Friday, so check that out on our articles page, really focusing on some of those themes related to the deterioration in breadth conditions and the rotation lower potentially in some of those growth names. Going to take a moment here before we get to the final bar mailbag with a couple quick announcements. First off, we're going to do a webcast tomorrow on Tuesday the 27th called The Market Top Checklist Revisited. There's still time to sign up. Go to marketmisbehavior.com/top, TOP. Bonus points if you can tell me as we start the webcast what mountain I'm showing in our in the promotional materials I made for this. If you're from the Pacific Northwest, it may look kind of familiar, but if you're not, you may have to do some Google image search to figure out what it is. But you can sign up for that event. We're going to take our top checklist, our market top checklist from 2021, update it for 2023, look at the current conditions, and see what we would need to see to turn pretty bearish on the market conditions here. Again, sign up, marketmisbehavior.com/top. Also wanted to let you know our mailbag is fueled from questions from all of you. Email is the best way to get your questions in front of us. We've received so many great questions so far in 2023. Please keep them coming. Our email is thefinalbar@stockcharts.com. On Twitter, just tag us at FinalBarSCTV. And on our YouTube channel, just put a comment right below the Final Bar video that you're watching. We'd love to hear from you. We'll hope to answer your question at our next mailbag segment, end of this week on Friday's show. Let us crack open the Final Bar mailbag. Thanks again, everyone, for sending in questions. Here is question number one for the day. Dave, what does a 10 to 15% drop usually look like? And that is a breakdown of a much larger question. You had some really thoughtful questions about, when you talk about a 10 to 15% drop, does that mean the S&P? Does that mean the Dow? Does that mean the NASDAQ? Would you expect individual stocks to drop 10 to 15%? What do you really mean? So here's what I would tell you. There is a lot of ways we summarize something like a drop in the market, and this is going to play on I'd say a technical building block of price data, which is beta. And beta is basically a measurement of relative risk or really relative volatility. Here's what I would tell you. If the S&P moves up 1% and an individual stock tends to move up 1%, you would say that has a beta of 1, meaning it moves in line with the S&P, kind of the same amount. Something a little more speculative, something like an emerging technology stock or a biotech stock probably has a beta well above 1, maybe up to 2 or plus, which means a beta of 2 would mean when the S&P tends to go up 1%, this stock tends to go up 2%, tends to be double the returns. Something more defensive like utility stock, right? Sort of a lower volatility, really sluggish name might have a beta below 1, something like a beta of 0.5 or 0.6, meaning if the S&P goes up, it tends to go up a lot less. So that's a measurement of relative volatility, and it's a different way of looking at something like average true range or historical volatility, some way of measuring relative movements. But beta is something we'd use often in the institutional community because you want to understand how your portfolio is going to tend to move. If the market moves down 5%, is my portfolio going to move down 2% or move down 20%? And understanding that beta can be vital to making sure you don't torpedo your portfolio if things start to go bad. And also understanding how you stand to perform. An emerging growth portfolio, like a speculative technology portfolio, might have a beta way above 1, and that's good to know. So if the market's working, your portfolio is going to do a lot better, and you're going to probably outperform. Now, the reason why I say all of that is because when I would say the market might go down about 5 to 10%, unless I'm calling out a particular chart, I'm probably referring to the S&P 500. If you think about what that would mean for the S&P, we have a percentage change tool in the annotations. So click on annotations, click on percent change. You can actually click on the current level and actually just drag it. You can see what a 10% drop would look like. So a 10% drop from today's close would take us down to around 3,900. So when I say 5 to 10%, I'm saying, does the S&P go down around 4,200, 3,900, something like that? Would be the level. So what would that mean for a portfolio? Well, that depends on your beta, right? That depends on how risky you're positioned right now and if you don't make any changes to your portfolio. It depends on what types of names you would own. If the market would go down 10%, certain things are going to go down a lot less than that, right? Certainly more defensive things like gold stocks could actually go up. What could go down more than that? Leadership names, right? Technology stocks that have been leading the way higher that actually are going to retrace a lot more could go down a lot more than 10%. Maybe it's 15, 20%. So when I talk about different potential outcomes, this is a normal thought process I would encourage you to do, is think about what would happen to my portfolio in its current condition if the S&P, tomorrow was down at 3,900, or over the next couple weeks is probably more realistic. And what would that actually look like? In terms of time frame, you actually also asked about the time frame. I'm a little less particular about the time frame. There are certain technical approaches, things like Elliott wave and Gann, cycle analysis. People like Larry Williams do a really good job of trying to project a forward-looking cycle. That is not an area of technical analysis I tend to spend a lot of time. I do pay a ton of attention to seasonal cycles, seasonal tendencies. I think there's a lot to be gained there. I don't sort of think about potential cycles and analogs and a particular date when something might turn. But the Elliott wave toolkit really thinks about different pullbacks, right? Is it a short and shallow pullback? Is it a long, more protracted pullback? And there's called the rule of alternation. I'm digging in my Elliott wave, an Elliott wave hat that I have to dust off to put on here because I don't use it often. There's a rule that, if one pullback is sort of a quick sudden one, the other one might be a gentle, lower sloping one. Again, personally, I don't pay as much attention to that. I certainly pay attention to key price levels and certainly pay attention to price and moving averages and momentum. And all of those really tie into how a pullback would actually play out. So that was a long-winded answer to say there are a lot of things that a market could do. I think when we talk about 5 to 10% drops or 5 to 10% rallies, we're generalizing. What you have to remember is if the benchmark does a certain thing, individual stocks and ETFs can have very different experiences. I would encourage you to dig into a data point called beta, which could help you maybe anticipate how your portfolio, how a particular position may react in some of those conditions. Great question, by the way, and let's get to question number 2. Dave, what would you say about a chart with stochastics rolling over and the MACD turning up below the zero line? And he sent me a picture of your own chart using a match card. This is actually not a picture. This is a permalink. So thanks again. And by the way, when you're sending in a question on the Sharp Charts engine, just click on permalink. In ACP in the lower left, there's a little arrow that's like the share arrow. Copy that link into your question, and I'd be able to bring up a live version of whatever chart you're asking about. Super easy and super helpful to do it. Now, you were asking about this one, and I think you were sending this right around this point. It might have been a couple days before, you sort of early last week, because things have changed just a little bit. But I think what you were saying is the MACD's turning up below the zero line. The stochastics is high and rolling over, and what would you do there? So how do you kind of reconcile? This is a little more bullish, a buy signal from the MACD. This is a little more bearish. So what I would say is with different indicators, there are different signals in different time frames. And so one of the schools of thought is to have a series of indicators and then use it as a checklist. And what I would honestly do is I would take this chart and just go from top to bottom. What do each of these indicators tell me about the stock? Thumbs up, thumbs down. Now, personally, looking at the number of indicators you have, I would argue you have a lot going on here. You have relative strength, Bollinger Bands, volume, some other moving averages that aren't part of the Bollinger Bands but are still there. Stochastics, RSI, MACD, and Bollinger Bandwidth, so technically still part of this. That's a lot of stuff, right? And I would say the good news about having that is you're kind of covered. You have eyes on everything. The bad news is analysis paralysis is a very real thing. And I would encourage you to think about one or two, if not more, of these indicators you maybe could swap out. Focus on some of them that are a little more similar to others. You probably don't need all of these to get a good read on the stock. But again, I think that's just something I would think about just looking at this chart with fresh eyes. So how do you reconcile these? Well, the PPO or the MACD is based on a little bit of a longer time frame. You're using 9, 21, and 9. So those are the exponential averages that you're using. Stochastics is actually a little shorter term because you're using 12-day and 3-day. You're smoothing it out a little bit, but it's still looking at a little less time frame. And the calculations are different. This is looking at the trend in the moving averages and the difference between them. This is actually looking at where the price is relative to a range over a period of time. This is using exponential averages. This is not. It's actually using just a simple average. And so you're going to have some disagreement. That's the challenge of having all of these indicators at the same time. What I would generally say, though, for me, I found stochastics to be a great indicator of mean reversion. Even the slowed version tells you a lot about when something's had a run and it's really starting to turn lower or higher. So looking at when the stochastics is extreme and then kind of comes out of those regions. The PPO or the MACD indicator, the way I tend to use it, is a little better at really confirming changes in trend. That's why I use RSI and the PPO together often. That's kind of what you're doing using stochastics and MACD. But I think some of these, like stochastics and RSI, very similar. So I would say you could probably swap one of those or get rid of one of those and just focus on optimizing your toolkit using one of those indicators. That's what I would suggest to you. So that's why there's a bit of a disagreement, just the difference in calculation and what data they're actually looking at. And again, my feedback, and again, thanks for sending in that chart, I would simplify a little bit. And you maybe don't need to have all of those indicators because you will often have conflicts if you have that many indicators on one chart. Next question. What makes sector ETFs move? And I'm summarizing a longer question that you have. And again, some of you really send in some thoughtful questions, and I appreciate it. I just need to edit them for content so we can show them on the screen. But you basically were saying when a stock moves, you're following ETFs. You really like Julius de Kempener's show, and I would agree. He's a brilliant analyst and developer as well, and I love his work the same. Does an ETF move because people are buying or selling the ETF directly, or does it move because the stocks within the ETF? And you mentioned the XLK in particular. So here's the answer. It's complicated. and I'll try to summarize in digestible format how ETFs actually work. And I would encourage you to go. I don't know if we have a great StockCharts article on ETF construction. I would Google that and see if you can find something good. But the way I would describe it is this. ETFs, there's two markets, right? There's the primary market. And think of it like if you know a stock, right? For a stock, there's the IPO, it's called the primary market, which is a company issues shares. And then there's the secondary market. You go into your brokerage account and you buy Apple or sell Tesla. So you're not buying and selling stocks from the company. You're buying and selling stocks from other investors. Could be big investors like a Fidelity or a a big fund company, or it could be an individual investor, depending on what kind of size you're working with. With ETFs, it's kind of the same way. ETF providers, the fund owner, the fund provider, actually there's a primary market where shares of the ETF are created or redeemed. And those are big chunks that big fund companies who have an agreement with the fund provider actually do. The secondary market is what you and I would do going into a Schwab account and buying or selling shares of the XLK. In reality, these two things are very closely related. And the reason why they're very closely related is because it's highly unlikely that everyone would not want to own Microsoft and Apple, but really want to own the XLK, because people are usually probably doing the same things. They're buying Apple and Microsoft. They're also buying the XLK. They're selling the same thing because a lot of the drivers of investors are going to be the similar, and they're going to be different ways of expressing the same sort of point of view. The reality is, though, there could be a gap between the buying and selling, the creation and redemption, and the net asset value, or the value of the individual stocks that the ETF actually owns. The good news is, in that sort of scenario, there's a whole market called an arbitrage market, and this happens in pretty much all investment vehicles. There's no way that these two things are directly tied to one another, but there are a lot of firms that do split-second trades to bring things back into the right amount. So if at any point the value of the ETF would get too far away from the value of the underlying shares, someone will sell the ETF and buy the underlying shares and bring it right back in. It happens so often and so in such a liquid way, you probably don't even know what's going on. And these are little millisecond type of things that big providers do to try to, and big brokers do to try to arbitrage the system. It's called an arb desk or an arb trade. So long story short, when you are buying or selling, when the XLK moves, it really is because the assets are moving, and the supply and demand between the underlying stocks and the XLK evens itself naturally because of the actions of the big market makers, or the big providers that work with the ETF company to make sure that runs pretty smoothly. And even in periods of big dislocation like 2020, it really actually held up very, very well, surprisingly well, given the fact that those are not directly tied in. That was as best as I can do in 3 to 4 minutes answering the question of how sector ETFs move, but I hope that answers your question. Final question, what candle patterns should we look for in a bull market? I'm going to do something a little unusual. I'm going to bring up a PowerPoint slide, and I'm going to draw some examples for you. And this is a true story. I was doing a training at the Citi FX desk, and this was in New York. Actually, the equity desk years ago. Once a week, I would go down there, and when I worked with Bloomberg, and I would get all the, whatever traders I could get off the desk at like 7 a.m. I'd get them in a room, and I would show them some charts, just some ideas of what they could look at during the day. The one time my laptop completely fried, wouldn't turn on, I couldn't get it to work. So I got out, I'm not kidding, the napkin from the coffee shop where I'd gotten coffee in the lobby of the building. I got it out and I started hand drawing some candle patterns. I showed them to each of them, they took notes. It ended up being one of my most successful trainings because I didn't worry about all the other stuff and I just focused on, look, here are a couple things you need to know. So I will try to recreate that magic that about 20 years ago that I remember doing and show you what I would do. In a bull market, what you have to remember is sort of the market sort of in an upward phase. That's sort of what you have to remember. So what would you look for? So the first one I would say would be a bullish engulfing pattern. And that's kind of like this, where you have you're in an uptrend and then you kind of get this going on, right? So this is a big, an uptrend, a big up candle, and a down candle. That's my crude ability to shade a candle. So big up bar, big down bar. And they're a little like the highs and the lows, the stem as we call them, or the wick are kind of there. It doesn't really matter. What matters is the body. Big open candle, big down candle. That's called a bearish engulfing pattern. That is a big warning sign in an uptrend because it tells you big up day, the next open, you gap higher, but by the end of the day, everyone's been liquidating, right? There's been more selling pressure, and we're undercutting the range of yesterday. That is a big red flag. Second thing I would look for in an uptrend would be what's called a dark cloud cover. And think of it as just like the first example, but instead of getting below the first day's open, you just kind of get really close, right? So it's kind of like this. So you have a big uptrend, you have an up candle, a down candle, and the second one, instead of getting down here, which would be a bearish engulfing pattern, you just get over at least halfway through this candle is kind of the rule. And as long as you get down through that, that's called a dark cloud cover, and it is as foreboding as you can imagine based on the name of it, right? Same thing. Buyers are just super happy, demand is outweighing supply, and then something changes. And again, candle charts don't care why something changed. It just looks at the supply and demand, and that often, again, is sort of a major topping signal indicating that things are reversing. The third thing I would look at in an uptrend would be what's called a shooting star candle, and that would look kind of like this. Right, so you have an uptrend, you have an open and close, and it doesn't matter if the open or close are on which side. It doesn't really matter. What matters is you open at a certain point, you traded much higher, and then you close back toward the lows of the day. So little to no lower shadow, big upper shadow. And again, think of the dynamics, right? We're in an uptrend. We trade higher. So midday, this is looking awesome. This is looking like this kind of day where it's like a big up move. But then by the end of the day, this kind of candle has turned into this kind of candle because all the sellers have come in. The buyers are exhausted. There's no one left. The anecdotal last buyer has made the trade. And as a result, we come back down. And that usually is a bearish sign as well. So that is what I would tell you. If you're looking for 3 candle patterns, and this is what I would be looking for on charts like NVIDIA and Tesla and those sorts of big leadership names, particularly when things get overbought, look for those kind of candle patterns. They will literally jump off the page at you. Once you're looking for these and you see one, you go, oh my gosh, that's the candle. By the way, on the StockCharts platform, if you go to Charts and Tools, we have predefined technical alerts which actually use or predefined scans which actually use some of these candle patterns. So you can automatically scan through the universe and look for stocks that have that particular, those bearish candle patterns. We got to wrap the show, folks, and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. You know, I was looking over the weekend at offense over defense. This is one of my favorite charts to think about the rotation within a sector, within the consumer sector. Are investors rotating more to the offense, things you want, or more to the defense, things you need? Now, this is a version of a chart that I show very regularly. It's part of my Mindful Investor live chart list, which is a list of names or a list of charts that I look at literally every day just to get a sense of where things are at. And I encourage you to look at that list if you don't have a good routine in the morning. Start with that because it'll really sort of give you a good overview of where things are at. I'm looking at the equal weighted version of this ratio, which is RSPD, which is the equal weighted consumer discretionary, RSPS is the equal weighted consumer staples. Those tickers just changed a couple weeks ago, so if you're not familiar with those, make sure they used to be like RCD and RHS, so make sure you update those if you missed it. This is the relative strength. You can see it bottomed out in July of last year. In December of last year, really started to pop, and that was in January. From there, it sort of had this rounded pattern that sort of played out to where we're at now. The signal, or the ratio is just starting to rotate lower. I put a PPO indicator. That question about the MACD that included that on the charts made me think, what would this indicator tell you? And what it's telling you is basically sell the ratio. What it's telling you is we've now rotated to the upper end of the range. We're now rotating back to the downside. The last time we had this signal was in February, which led to about a 6 to 8, not more, week period where the defense of staples really outperformed the offense of consumer discretionary. This is a common technique to use for something like pairs trading. If you're trying to pairs trade 2 stocks or ETFs, this can be a really interesting combination to try to do that. So maybe indicating here a rotation impending to more of the defensive side of the equation. Chart number 2, Carnival Cruise Lines were a really rough group today. CCL on earnings down about 7.6%. I didn't have time in our market recap to get into some of the cruise lines, but cruise lines have been some of the better areas of the market here in 2023 outside of technology. You saw them move higher and now a gap lower today. Overbought until today's sell-off, which is taking it out of that overbought region. The reason why I think this chart is so fascinating, look at how it lines up with the Fibonacci retracements. Take the high from June of 2021, which is the all-time high for CCL. Take the low from October of 22, here just above $6. You can see we have retraced 38.2% of the way. And now we're gapping back down. So an expected move as we're overbought, testing a key Fibonacci level. That's why I use this combination of indicators and why I like to focus on names when they are reaching those levels. Finally, Uber. Let's finish the show on a high note. Some stocks just keep working, whether or not you think they should, whether or not you can debate why Uber should be in an uptrend. Uber made a new high for 2023 today. It made a new 52-week high today, up 2.5%. I'm inclined to follow charts and follow trends like that until proven otherwise. The trend is still positive. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. All of our previous interviews, some really good discussions are on our YouTube channel, so go through that playlist and check out some of those previous discussions. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.